Hello, and thank you for joining our mid-year review and outlook. We hope that wherever you're coming to us from, you're enjoying the summer swelter, which I think is applicable this year to just about everyone, no matter where you are. So thanks for taking a few minutes to jump on and check out what we have going on today. What we wanted to do is we went over about the next 30 minutes. We want to simply share with you our thoughts on the investment markets over the first half of the year, focusing on the topics that we've gotten the most questions about. Volatility, tariffs, inflation, and the tax bill are going to be the things that we're gonna kind of focus on throughout today. Everybody's joined in listen only mode, so if you have questions, you can just type them into the questions box and we'll try to address them on the fly. If not, we'll get to them at the end. And if for some reason we don't get to your question, we'll make sure that we follow up with you individually. So with that out of the way, let's go ahead and get started here. Like I said, we're gonna talk about what's happening in the markets for the first half of the year, and then follow some of those topics that are top of mind to everybody before we kind of look forward to what we see happening in the back half of this year. So again, before we get into those topics, just a quick look at the performance of the major market indices over the first 6 months of this year. As you can see, everything is positive with the exception of small cap stocks. Those small cap stocks were down a little over 4% through the first 6 months of the year. And it's really a result of when there was a risk off move around the tariffs, which we'll talk about here in a little bit. The small cap stocks sold off more and never fully rebounded to the same extent that the S&P 500 and large cap stocks did. So just kind of looking at what did happen in the other markets that were positive, the S&P 500, the large cap US stocks up 6.2% through the first half of the year. The S&P 500 equal weight up close to 5%. So why this is interesting is that hasn't been the case the last few years. What we've seen is that the regular S&P 500, which is market cap weighted, where the largest companies are the ones that have the biggest influence on the returns, those largest companies, the NVIDIAs, the Metas, the Apples, Googles of the world, those largest companies, really the AI tech companies, were just performing, gangbusters, more so than everybody else, that it was dragging the entire index up. That's why the market cap weighted S&P 500 had really significantly outperformed the equal weighted index, where the equal weighted index, all 500 of those stocks are weighted equally. Therefore, those larger companies don't have as much of an influence on the returns. So what that tells us is that what we've seen so far is a very good sign that the positive stock market performance is broadening out to more companies than just those few largest companies in that tech sector. So that's one big takeaway. The other takeaway I want to point out here, which is extremely significant, is look at the performance of international stocks. The EFA index is an index of developed country international stocks, primarily a whole lot of Europe and a whole lot of Japan. What we saw up almost 20% for the first 6 months of the year. Emerging market stocks, which is going to be China and some other Southeast Asian countries primarily, up over 15%. Significantly, both of them significantly outperforming US stocks for the first time in a long time. And that could just be a blip on the radar, or that could be a trend. We're going to talk a little bit more about that towards the end of today's presentation. So final thing to mention here is the bonds, the safe part of portfolios, up 4% through the first 6 months of the year. So you're able to get 4% with some of the more conservative safe parts of the portfolio through the first 6 months of this year. Mike, anything to add to any of that?
No, I think the big thing to add, and I think we'll talk about it on the next slide, really, is that while everything here is positive, it wasn't a smooth ride to get there.
Good segue, Mike. Let's do it. So we'll hit our first top of the mind category here is going to be volatility. We saw a lot of volatility in the first half of the year. So Mike, walk us through it. What happened?
Yeah, we came off strong 2024, right? We came into the year, we had a post-election rally that rose the S&P 500 and basically every market actually into the end of 2024. And then we came into 25 and actually enjoyed a little longer rally through Inauguration Day. And then we kind of hit the first blip of the year when we got to the DeepSeek sell-off. So DeepSeek was a Chinese AI that came in out of nowhere, really. And all this CapEx spending in the United States and was really driving the stock market at the time was all AI driven, right? So that ChatGPT, Grok, Gemini, they were all going to be the best AI applications, and they were all US based, and that was really driving the market higher. And then all of a sudden we got this disruption from DeepSeek, who came out of China saying that they were doing all the same things, maybe even better, with less chips, less money. Really disrupted what was happening in AI, and are we really like a leader? Is the United States really a leader in this? And it really started to upset the US markets. And that's kind of the first thing we saw in volatility for the year, and the trend has continued for the rest of the year. We ended up hitting an all-time high shortly after that. But then as soon as the talks about tariffs started happening, starting with like Mexico and Canada, those tariff talks started, and the market started inching down from there, which is, as you saw in the last chart, S&P 500 was up almost 11% for this quarter, but only up 6.5% for the year. And that's because towards the end of the first quarter, markets really started dropping because of the tariff news that was happening. And then things kind of settled out, and we kind of were at a lull where we were kind of keeping in between a band of trading, really, until Liberation Day. And then when Liberation Day happened, and that's when they released all the worldwide tariffs, we got almost a 20% pullback in the market from the all-time high. And it was in a 5 or 6 week span that we really went from all-time high to a bear market almost.
I think it's worth, Mike, just jumping in. I think it's worth pointing out here too, if you look at the darker line, that's the bond market. So that's the bond index. So after Liberation Day, when the tariffs came out, that really surprised everybody just how high those tariff rates were that were announced on Liberation Day. There was a sell-off in both stocks, the stock market and the bond market. But as you can see, the bond market, it sold off a couple percentage points, not the full 10, 15 point drop that we saw in the stock market. And that's why you own bonds in a portfolio. So just wanted to point that out.
It was still considered for bonds considered a pretty volatile event just because of how high the US Treasury rates spiked during that time frame. But again, that's why you hold bonds. Their relative value, volatility to equities is just very different, right? And it was the buoy in most people's portfolios during that time. And then since then, volatility has kind of hampered. And that was because, on April 9th, they said they were going to do a 90-day pause. They then extended that 90-day pause, all the way to August 1st, which is just a week away at this point. And we've really since then seen the market climb back in what is one of the fastest recoveries we've ever seen from a bear market. And we actually hit the all-time high again on the market, and on the S&P 500, that is. And then shortly after that, we got the tax bill, which is another thing that we'll talk about here in a little bit. But even today, we got news that Japan and the United States have reached a trade agreement. We still don't have trade agreements with Europe, which could obviously bring, and many other countries, which could obviously bring a lot of volatility still for us in the near future, as we have to get these things hammered out. Unless it gets past the August 1st deadline, then they're going to be putting some pretty steep tariffs on all these other countries, and which should also bring retaliatory tariffs as well.
Yeah, I think the big picture takeaway that we wanted to kind of communicate here as well is that this is just a reminder that if you're invested in stocks, you have to expect volatility. Volatility is very normal in the stock market. I think we've been a little bit spoiled over the last few years where we haven't seen a whole lot of these, kind of quick drops. So it's important to know that they will happen. So I think this is always an interesting data point here that I like to share with people. It's, you can see that, despite the fact on average, this is just looking at each calendar year for the S&P 500, on average, the S&P 500 drops 14% within a year. That's for it hits a peak and then it drops intra-year by 14%. Never feels good when that happens. And as you can see here, we saw a 19% drop during that period that we just looked at. So, but despite all that volatility that you see that we've become accustomed to on an annual basis with being stock investors, the stock market, the S&P 500 is still positive, 75% of the time. So in 34 of the last 45 years, despite these intra-year drops, the S&P 500 is finished positive. So.
Yeah, and I think that, obviously the strong point that can be made there, right, is if you look at some of these years, like, you see many of them, if you go back to, 2019, for example, negative 34% drop in that year, but you end up 16% for the, at the end of the year. As long as you're not overreacting during the time periods when the market's going down, it's really where you end up, not how you get there, matters at the end of the day.
Yeah, and I think it's been an emotional year for a lot of people, and I think people don't always make the best choices when people are, when you're overly emotional. And sometimes we see that in the investing world where, you get stressed out because of work, because of politics or what have you, and people want to kind of question their investment strategies sometimes, and especially when they see these kind of drawdowns. So we've had a lot of conversations, just kind of helping people understand, reminding people of the volatility of being a stock market investor. So wanted to spend a few minutes talking about that. I want to transition now into the second thing. It's really kind of the big issue of the first half of the year, and it's still very much on the forefront of what's probably going to drive, or definitely going to drive the back half of the year, and that's tariffs. So the big shock on April 2nd that we saw was just the size of the retaliatory tariffs that were announced by the president. We knew coming in with the new administration that tariffs were on the agenda. The expectation was about a 10% tariff rate. And then on April 2nd, quote, Liberation Day, just the size of those retaliatory tariffs, like 135% tariff on China, and, similar, not quite to that extent for several other countries, just far exceeded what anyone had expected. And that really forced the investment analysts and the economic analysts to go back and adjust their forecast for the future. So adjust earnings down and adjust economic growth, which really is what played into what you saw with the volatility in the first half of the year. Well, a week after April 2nd, as we all know, the president postponed the retaliatory tariffs to give time for negotiation. The first pause was till July 9th, and then it was extended to August 1st, which is just a week away as we sit here today recording this. So based on what, the research that we're looking at, and this comes from the Yale Budget Lab, it looks like, the tariff rates, once they're negotiated out, are going to settle somewhere around 17%. And that's a number that's kind of been fluctuating around over the last few weeks, and it will continue to fluctuate as we reach that August 1st deadline. So expect to hear a lot more about new agreements being made over the next couple of weeks. I think just today is the 23rd. We had this morning woke up to news that there was going to be a 15% tariff rate on most goods out of Japan. So a deal was reached with Japan, and then this afternoon there was some headlines that it looks like a deal with Europe should be reached shortly. So the market is going to digest these agreements as they happen and as they don't happen. So, for instance, the 15% tariff rate on Japan is less than the 25% that a lot of people were expecting. So the market's going to react positively to that. The big trading partner that's still out there that haven't struck a deal with is China, right? That's the biggest one. So leading up to this August 1st deadline, if there is no agreement with China, we could see the market show some signs of concern. Conversely, if we do start to see deals being made, continuing to be made, and that uncertainty about if deals will get done kind of fades away, then we could see the market celebrate that. So just what we talked about
today. I think you saw that today with Japan, right? That was a big concern. Japan's a large trading partner. And so because of those trade tariffs went from, for most items, 25% down to 15%, and then the market rallied about 500 points on the Dow today after the news of that. And I think a lot of that just has to do with, and anybody who's ever talked to me about the markets, the one thing I tell people all the time is that one of the things the market hates the most is the unknown. And so getting an answer sometimes, whether it's the market wants 12% or 14% tariffs and they get 15, sometimes the answer alone is enough to help the markets at least be able to price in what does that mean.
Right, yes, uncertainty, the market does not like uncertainty. And as it relates to tariffs, what investors worry about when it comes to tariffs is really two things. It's inflation. Is it going to have an impact on inflation? And is it going to have an impact on corporate earnings? So let's just take a look at inflation. Now, this is a kind of a busy chart here. It breaks down all the contributing factors to inflation. But for our purposes, I just wanted to illustrate that, as you can see, the rate of inflation has come down significantly since peaking in 2022. The inflation report just last week, which is a month ahead of this, was 2.7% year-over-year growth in inflation. So that's a slight tick up from the 2.4% that we had the month prior, that we had in May. But it's still well below concerning levels. But it's also above the Federal Reserve's 2% target. That's why the Federal Reserve's kind of in limbo now and holding off on cutting the Fed funds rate, because they just want to see, all right, the tariffs are just now starting to have their impact, and we want to see if, in fact, the tariff, the increased cost of tariffs are going to present themselves in higher prices for us as consumers, which would be inflation. And if we do see that, if we do see higher prices, well, that's going to mean that consumers might have to start pulling back on some of their spending, which is going to drag down the overall economy. So that's kind of where we're at with inflation. It's coming down, but maybe we just need to see with the tariff impacts starting to show their effect. Could inflation start to tick back up? Mike, anything else on inflation you want to add here?
No, I think, one of the big things is like you mentioned, the unknown about the tariff side of things. And the big thing is do they pass all the cost on to the consumer? Do they pass part of the cost on to the consumer? Or do they absorb those costs? And I think we're going to go to the next slide and it'll show that if they absorb all those costs, you're not going to feel it in your wallet necessarily every day at the store, but we will see it in earnings of companies.
Yeah, the increased cost has to be assumed by somebody, right? Is it, are the companies that, what we see on the left here of this chart, this is the ISM manufacturing price. It's basically the price of the raw materials that go into the goods, to manufacturing the goods that we all consume and produce. And what you can see that the cost is definitely going up. So the cost of the raw materials is definitely going up. So it's costing manufacturers more to produce things. So what's going to happen there? Are they going to pass that increased cost on to us, or are the companies going to absorb that into their profits? So what you can see here is revisions of what margin or profit forecasts are for companies. They've been revised down because of the tariffs. And you can see, there's some sectors are impacted more than others. The outlier down here is the auto industry, is the one that's most impacted, and that has a lot to do with the steel tariffs that are going to hamper the auto industry. But we've already heard from a lot of companies as we've started Q2 earnings over the last couple of weeks. We've heard a lot of companies come out and talk about the fact that they're seeing their earnings are being squeezed by the higher cost. A lot of the canned goods companies, Bush. We were talking about this morning, Bush beans. This is baked bean season where, we eat a lot of baked beans in my house, and apparently them, like all the Bushes, just like all the other canned good companies are feeling the pressure of the aluminum and steel tariffs. Again, we're going to see if who most likely, to your point, Mike, you're going to see some price increases for us as consumers, and you're going to see some margin compression, as companies absorb a lot of that cost, and it's going to hit their bottom line. So that's something that we're going to be paying attention to as we look at quarterly earnings reports this quarter, and then I think you'll see them more in the next quarter as well.
And I think long-term too, one of the other things that you see is if tariffs remain high from somewhere that aluminum was coming for canned beans, for example, longer term, if the tariffs are going to stick, then you're going to see some supply chain just changes, right? They're going to look for alternate sources for those items to try to balance out how much they can pass on to the consumer and how much they have to actually absorb into their own bottom line.
So, and that's it. I mean, and this is won't dwell on this point much more, but just want to point out the fact that, when companies earnings disappoint, meaning they miss what their what their earnings forecast are, they get punished much, much more so than their stock price gets punished, much, much more so than when they beat or they exceed what the expected earnings are. So you can see, you feel about a 3.5 or 4% drop when you miss earnings on average, as opposed to when you beat, you see, marginal uptick, and not even in the most recent quarters. In the most recent quarters, you haven't even been rewarded for having upside surprises on your earnings. So to the degree that we start to see earnings forecasts come down, and we start to see companies announce that their earnings, that they're missing their earnings numbers, that could be a drag on the markets going forward. So it's one of the things that we're looking at. Mike, why don't you wrap us up with the final thing that's on people's mind so far this year?
Yeah, the one big beautiful bill, which is funny to say, but so the tax bill, a lot of which was really just an extension of the 2017 TCJA, making a lot of those provisions just permanent. So, what it does for most people is it's going to, keep that highest tax rate. Instead of going back up to 39.6 like it was supposed to, it's going to stay at 37. The other tax rate bands are going to stay a little bit more expanded than they would have been in 2026. A big one for people who live like on the Northeast corridor or on the West Coast is going to be the SALT deduction. So for earners basically under 500,000, they're going to increase that to $40,000 SALT cap from 10,000. Which is a pretty big change. There's the tip income, the overtime pay, the child tax credit. This is actually the first time the child tax credit has actually been put into like a permanent place and indexed for inflation. Usually they have to change it every year with congressional action. And then the big thing for businesses, and I think this is where it actually could be helpful for businesses and for the market, is the 100% immediate expense for a qualified property acquired. So a lot of that is just basically meaning that when businesses go out and spend on items, they can actually take that immediately and depreciate it versus having to do it over time like they had to before, which can help companies' bottom line more quickly and also can help companies make decisions faster in the long run, which could help, GDP and could help, the economy grow.
And the big investment, the big capital expenditure for so many companies now is data center construction and just building out their AI infrastructure. So this is just going to help that. It's just going to help kind of fuel the flames of that a little bit as well.
Yeah, and from what I've seen, most consensus estimates that this will add, 1 to 1.25% to GDP. Obviously, on the flip side of that, it's kind of a double-edged sword here. Is long-term, the concern is what does it add to the debt? Over the long term, and that's a long-term concern that I think a lot of people have, and something probably will have to be addressed at some point here.
Hopefully. So
maybe.
So we'll switch gears and we'll just kind of wrap up quickly, talk about a little more about where do we think we go from here. So we talked about some of the things that are playing out. And, here's what we're focusing on right now with clients, and that's first off, it's asset allocation. And we saw that there was volatility in the first half of the year. We want to make sure that we're managing that volatility for every individual client's risk tolerance and what their financial plan requires them to have from a risk reward standpoint. It's one thing where everybody could be 100% in stocks, right? But maybe emotionally they don't have that capacity to do that. So we're paying attention to the asset allocations that we have in place for clients, especially amongst the volatility that we've seen and maybe the volatility that we might expect to see in the future. We are, however, cautiously optimistic on equities, and I think we talked about, we'll talk about some of the reasons why there. We're tactically overweight international equities. We'll talk about that. And then we're also strategically using private credit, private equity within portfolios where it creates a little broader diversification and access to some non-publicly traded markets. So one of the reasons why that we are cautiously optimistic on the markets going forward is, the U.S. stock market's at a high valuation right now. Those tech companies, those artificial intelligence companies, they're expensive. They've run up quite a bit. But what we're just now seeing, and we're seeing that the AI usage rate, just look at the pace of the AI usage rate, that's in blue here. We know that this artificial intelligence is out there, they're working on it, but is it really being adopted and used in everyday life? Kind of like the internet when the internet came out, right? Like we knew it was a thing, but who was using it? How much were people actually using it? I mean, Prodigy took a long time to fire up when I first got internet at my house. So it wasn't until you start to see, different generations where technology gets better and the adoption of technology starts to just exponentially increase. And we're starting to see that with AI now. And you can just see what the projected usage rate is, going forward. So bottom line is AI is going to have a huge impact, not only on those most immediate companies that you think of, the NVIDIAs and the hardware companies, but as it gets adopted, it's going to help other businesses, industrial businesses, utilities and energy companies. All of these companies are going to benefit from it. And I think we're starting to see that a little bit. If you think back to the first slide when we talked about how the returns in the S&P 500 are broadening out to more than just those 7 big names that have dominated things for the last few years. We're starting to see that broadening out, which is a really healthy thing for markets. And I think AI is just a big part of that story, and it'll just help improve profitability for companies going forward. The next thing, Mike, you want to take this one and just talk about, international stocks? We're overweight international and kind of how that's played out.
Yeah, we're overweight international. We came into the year overweight international. There's 2 components to international. There's how international stocks are doing. As U.S. investors, there's 2 components to it, right? There's how are international stocks doing, and international stocks have done well because they're not facing quite as much of the tariff burden that's happening over here. And we kind of saw that in March and going forward. But then that second component that's really important is how is the dollar doing, right? It has kind of a seesaw effect that if the dollar weakens and goes down, then your international stock portfolio will go up because they're returning your money in that portfolio back in euros or whatever local currency they're investing in. And so that's been a lot of the return for international stocks this year has come from that currency component. And we saw a very strong weakening of the dollar, which started really right as the tariff started.
Yes, the first half of the year was the biggest decline. Dollar decreased 10%, biggest decline since 1973. Huge wind behind the back of international stocks, which is why you saw international stocks perform as well as they did.
Yeah. So you got a big boost there, and so far also valuations have been better, are a little bit more reasonable internationally for the last many years. So it's just a little bit of a catching up as well.
Yeah. Do you want to talk more about? So we think that the dollar story was a huge tailwind for international investing in the first half of the year, but not sure that the dollar is going to continue to decline. I kind of hope it doesn't continue to decline at the same rate. So we don't think that international investments are going to continue to get the same sort of boost from the dollar, but we still are positive on international investments going forward. And we've written a lot about this on our blog. I mentioned before, I forgot to mention the AI conversation I had a few minutes ago. We're writing about that on our blog now. You'll see 2 articles just about how AI is expanding throughout the markets. We've also written about in our capital market assumptions, which is our long-term assumptions for investments going forward. We've written about the fact that we're very positive over the next 10 years on international stocks. And one of those reasons is, which Mike just alluded to, is that the valuations, and I won't go into this too much, I don't want to geek out too much on this, but 2 things, the forecast for earnings. We have not seen international stocks have the same level of earnings growth to US stocks. Hasn't even been close for a while. European companies just frankly weren't growing nearly as quickly as the US. However, you can see the forecast has changed. We're now seeing double-digit, the expectations are for double-digit earnings growth in 2026, 2027 for most of Europe. So in addition to better earnings growth, we also have a better starting point if you look at valuations. And again, I don't want to geek out on this, but you can just see that the different valuation measures, different ways to value if the market's expensive or cheap. You can see that the international indexes are much, they're at a much lower level than what the S&P 500 index, those large US cap stocks are. So positive on, this is part of the reason why we're positive on international stocks, but the reason why you see that the earnings projections are so much higher for Europe, a couple of things. There's some things happening in Europe that really are the catalyst for what we see as the long-term outlook. And one of those is that Germany has committed to spending 25% of their GDP on infrastructure and defense projects over the coming decade. Germany has not spent money for decades. They've been the poster child for austerity. When the rest of the world was spending money, they were not spending money, and it really hurt their economy. They just weren't investing in their own local economy. But there seems to be a philosophical change. Some of that has to do with some of the things that the president has said about NATO and the ability in pushing the European companies to spend more on defense. But Germany is the best economy within Europe, and so they're the ones that are leading that charge as far as investing in their local economy, which is great. The other thing too is in the central markets, the Federal Reserves of Europe, the central banks of Europe, they have a lot more room to stimulate their economies. They're not dealing with the inflation pressures that we're dealing with here in the US. So everyone there's a lot of pressure on the Federal Reserve to cut interest rates here in the US, but they're saying we can't. We're not sure what's going to happen with inflation. We've seen inflation's kind of ticking up. We got this tariff issue. Those aren't concerns for the central banks making those kind of interest rate decisions in Europe. So they have a lot more flexibility that if they do need to stimulate their economies in Europe, they can lower interest rates and not have to worry about the impact on inflation. So that's another, it's another thing that Europe has going for itself.
In June, unlike here, in June, ECB cut rates by 0.25%, whereas we helped.
Right.
And it seems to be the trend that's going to kind of continue forward.
And and the final thing is just kind of, again, philosophically, the European Union is kind of bounded together a little more than they have kind of in their history since this kind of new project started. So we've seen the countries working together more strategically as a way for them to stimulate their economies by doing some more cross-border transactions and allowing their capital flow across borders, which again, it's just more stimulative. We've seen a little bit of relaxing of some of the regulatory things that have been holding Europe back. Very highly regulated. It was tough for a lot of businesses to do business there, but we're seeing them kind of back up on that a little bit as well. So just wanted to kind of provide some context around why we're overweight international stocks. It's worked for us year to date, and we kind of expect it to continue to work, but we can talk more about that when we have our individual meetings. So I don't know, Mike, you want to just kind of bring us home here with kind of the summary we talked about?
Yeah, I mean, I think a lot of the things that are top of mind that we just talked about are still not resolved, right? That's kind of a big part of it. So near term, so the things we're looking at is the trade's still ongoing, right? So that goes back to what we were talking about with, being diversified and asset allocation and being prudent, right? Is not getting ahead of ourselves. That yes, the market has recovered quickly. The market looks good, and we're cautiously optimistic on the market. But that does not mean that it won't bring short-term volatility as we get towards the end of these trade negotiations and all the different tariff issues that we're going to deal with over the next, week to months ahead, right? Depending on how things play out. The tax bill, I think that's whatever way you lean politically, like that the tax bill should be good for most people. It should stimulate the economy, which is good. It should be helpful from that standpoint. So I think that's kind of a wind behind our backs in that sense. But longer term, like we mentioned here below, it is going to add to the deficit, which is a long-term problem. So there's probably going to have to be some sort of, coming together of politics to figure this out down the road. And the big thing also, and it goes, again, like everything right now kind of circles back to tariffs, is the labor markets and the path of interest rates, right? Right now, where we are today on interest rates versus where I think most of the consensus of the market was a year ago on where we would be with interest rates is we're higher than we expected to be. And I think that, given the inflationary, we came down with inflation like we were supposed to for them to cut rates, the Fed that is. But I think we had some uncertainty with some of the tariff things that were going on, and so they couldn't cut rates, or they didn't want to cut rates. And so I think we're higher on rates than we wanted to be. I think we'd all like the market, we get a big boom from rates coming back down, but we have to see where inflation heads before they can really do that.
Expect there to be headlines over the next couple of months, starting today, going through the end, certainly the end of September, around trade deals. That'll be the first thing that we're going to hear about, trade deals, deals that are made, deals that aren't made. And then you're going to hear a lot of people pontificating on what the impact of those trade deals is. You're going to hear both sides of the coin. You always do. Yeah. So we're going to hear a lot about trade deals coming out or not coming out over the next couple of weeks. And then the next thing is going to be in September. The expectations are, talking about interest rates, that the Federal Reserve will cut interest rates in their September meeting. If inflation over the next couple of months ticks higher, maybe the Federal Reserve does not cut interest rates as they are expected to. That would be a very big disappointment to the markets potentially if those interest rates are not cut, and you could see some volatility around there. So we're cautiously optimistic, but we don't think, we think there could still be some ongoing volatility because some of these stories are still playing out. So anyway, want to thank everybody for your time. And one of the things we're going to be doing portfolio reviews over the next couple of months for anybody that will be reaching out and reach out to us, proactively too, if you want to have a review of your portfolios. We'll start September, October, start doing end of the year planning. Part of that will be end of the year tax planning. Just looking at how does this one big beautiful bill impact you and your financial plan? What kind of things might we want to proactively do to take advantage of it? So we'll let everybody get back to their summer vacations. again, thank you for your time, and we look forward to talking to you soon.